Many investors live in fear of a bear market, commonly defined as a fundamentally driven drop of 20% or more in the stock market over an extended period. Market volatility of any type can be unpleasant, whether it's a bear market, a short-lived correction that pulls the market down about 10 to 20%, or even just a pullback of a few percent over a couple of days. It's scary watching the value of your retirement savings fall. Humans are intuitively programmed to hate losses more than they enjoy gains. This is referred to as myopic loss aversion. Because of this, we're naturally biased to take action when market volatility rears its head. It certainly seems logical. The problem is, taking action often leads to more investment errors than not over the long term. Being able to identify a bear market early on and take defensive measures before the worst of it happens can help your returns. But not every bout of negative volatility is a bear market. That means trying to sell out at any time markets turn rocky can often mean selling your stocks after they've dropped, then buying stocks back after they've already risen. In other words, getting whipsawed and missing out on returns you may need. This kind of investor behavior can have a far bigger impact on long-term returns than even the best portfolio management strategy. While market drops can be scary, we believe understanding indicators of a bear market can take some of the anxiety out of market volatility. If you can identify a bear market early on and take defensive measures, that's great, but it may not be necessary to reach your investing goals. After all, stocks' average annual return of about 10% includes all bear markets. That said, we believe being able to avoid some of a bear market's downside can get you to your goals faster. So, at Fisher Investments, we're always looking at market indicators to see if there might be a long, deep downturn ahead. 3 types of indicators we look at are euphoric investor sentiment, underappreciated negative fundamentals, and what we call market wallops. Bull markets typically end with investor euphoria, which is when all investors are nearly uniform in their expectation for big positive stock returns. The problem is, when most investors expect one outcome, very often the market does something else entirely. Stock prices move based on supply and demand, like any other widely traded good. In this case, investors have already increased demand dramatically and bet on the outcome they think is most likely. So there isn't enough additional demand to send the market higher after that. This is why euphoria is so often the last stage of a bull market and the first stage of a bear. Some signs that indicate euphoria include widespread belief that it's different this time. When media and investors are uniformly positive about stocks' potential, you'll likely hear comments about the environment being different this time. Past examples of this include the belief in the late 90s that dot-com stocks didn't need to generate profits, just clicks. Or back in 1980 and 81, that energy stocks would unstoppably rise. High leveraged buyout activity. When businesses have euphoric sentiment, you may see them taking on debt to buy competitors or fund major projects despite slowing or negative sales and earnings. Overpriced IPOs. You may also see low-quality companies extending initial public offerings in droves, which are then snapped up by investors at sky-high valuations. Increased fund inflows when money is flowing into equity funds and very little is coming out. It's generally a pretty good indicator that investors are feeling good, maybe too good, about owning stocks. Usually, euphoria doesn't cause a bear market by itself. It often goes hand in hand with weakening or underappreciated negative fundamentals, which euphoric investors generally ignore. While one negative data point doesn't mean a bear market is likely, broadly declining fundamentals against a backdrop of euphoria is often a bad sign. A few of those negative fundamentals to watch out for include weak corporate earnings. While earnings and stock prices don't always move in the same direction in the short term, it can be a bad sign when investors ignore persistent or widespread weak earnings. Faltering revenue growth. This typically signifies a decline in demand, a key economic driver. High inventory. This can be a sign of weakening consumer demand, again, important for the economy. A wallop is a huge, unforeseen negative big enough to knock a few percentage points off global economic output. Usually economic output grows by a few percent per year. A wallop needs to knock all of that growth off and cause a contraction. Potential wallops include global trade war. While extreme global barriers to trade can wallop the market, note that smaller scale trade wars between individual countries are not enough to cause a wallop. Regulatory changes. If significant regulatory changes negatively and broadly impact businesses, they could become wallop worthy. A major geopolitical conflict. Again, note this would have to be broad in scale in order to knock a bull market off course. Regional conflicts aren't enough on their own. These are just a few of the many factors we look at when we try to identify bear markets. However many factors you look at, however much data you have on hand, navigating a bear market can still be tough, especially on your own. To get updates on Fisher Investment's take about what's happening in the market, whether it's a bull or a bear, click the subscribe button below. Also, feel free to comment to tell us your thoughts. Thanks for watching.